accountants and advisors, we are here to help you solve your China business pain points. One of your goals is undoubtedly to increase revenue in China. Increased revenue often leads to increased profits, but there are situations where increasing your revenue may cause profits to decline. And in this episode, we will discuss 4 reasons revenue is increasing while profit is decreasing. It is helpful to get a baseline understanding of the relationship between revenue and profit. Revenue is what your business receives as payment for goods or services, while profit consists of revenue minus all of your expenses for that period. So, fixed costs and expenses are one of the biggest reasons your company's revenue is increasing while the profit is decreasing. Fixed costs are costs that do not change with the level of the business activity. Example of fixed costs would be rent, loan payments, salaries. Variable costs are costs that do change as activity levels change. Some examples of this would be material costs, hourly labor, sales commissions, etc. Separating fixed and variable expenses is important as it can help narrow down areas where costs may be running higher than expected or higher than actually budgeted. So, looking in more detail at expense and cost increases. Costs coming in higher than expected is one of the biggest reasons your business's revenue in China is increasing while profit is decreasing. This can be due to internal or external factors. For example, suppose your company requires a significant amount of cleaning supplies to properly complete services. And due to a shortage in a certain material, the price of cleaning supplies has gone up 50%. In this situation, the extra cost of a needed supply is caused by an external factor. And this has been realized in 2022, specifically by the Ukraine and Russia war. Similarly, if you decide to give your sales manager a 5% raise due to good performance the previous year, the increase in salary is an internal factor that increases your company's salary expense. Both those external and internal factors that increase costs will reduce your company's profit and are major reasons why your revenue is increasing while your profit is decreasing. Customer acquisition costs. Now, it seems intuitive that acquiring new customers will generate more revenue and therefore more profit. However, this is not always the case. There is often a cost associated with acquiring new customers, and these costs are another reason why your revenue is increasing and your profit is decreasing. For example, suppose the total cost to acquire a new customer is 100 renminbi. Each new customer brings in 80 renminbi in revenue. In this situation, you can see that although your revenue has gone up by 80, it's actually cost you more to acquire the client, and hence you're making less profitability. So it's really important to look at the marketing strategies that you're implementing to acquire new customers. And are you spending more on these marketing initiatives and not selling enough to those customers as you are acquiring them? Now, it is really important that in your financial management reports, you are going into extreme detail about your individual costs so you can truly analyze what is working for you and what is not working for you, so that you can decide either to limit the budget or actually eliminate that item completely out of your list. Now, one-time costs could be another reason why your revenue is increasing and your profit is decreasing. Unexpected costs include repairs, severance packages, because you have either terminated employees or employees have resigned, or other such situations, like, for example, warehousing situations due to COVID lockdowns, etc. Now, although these costs do not repeat themselves, it is important to track them accurately as one-time costs and realize that they are a major reason why you might not be as profitable as you had hoped in that specific year. Another reason might be an incorrect service mix. So, like manufacturing companies, service companies, trading companies need to utilize a service mix that yields acceptable profit margins, meaning that you need to understand what your profit margins are, i.e., what are your costs of goods and what are your costs of services, and that you are tracking that so that you are not spending more money than is absolutely necessary. You also need to set a goal and a strategy of what you want your profit margin to be, and make sure you track that on a daily, weekly, monthly basis so you know that you are actually making sure that you're tracking everything. Now, one thing I want to highlight is that in order to be able to track all of this, you need to have a solid and sound financial system in place. And you actually need to be able to read your management reports and analyze them in a manner where you are making decisions quickly. Because what we all want to make sure is that, yes, we've got high revenue, we're controlling our costs, and we've got high profitability, right? How can you control your costs, whether variable, fixed, or your customer acquisition costs or your profit margins, if you are not looking, reading, and analyzing your financial management reports? If you are at a situation right now where you cannot really understand them, or you don't understand how things are being booked into your accounting system, then that is a pain point, and that would be a reason why to reach out to us. So if you want more China business advice like this, then set up a 15-minute discovery call to go through your current pain points, and we'll see whether we can help you. I will provide you with a link to our diary where you can set up the call straight away. In addition, if you enjoyed this content, click the subscribe button so you can receive more content like this every day. And if you want to know more about what I do or what we do at Woodburn Accountants and Advisors, then please do go to woodburnglobal.com. Hope you enjoyed this video. See you soon. Take care and goodbye.